So as we progress with fixed assets, we're going to be seeing how we depreciate them, move them from the balance sheet to the income statement. And I will share screen, turn on the sound to share, and take a look at our Ben and Boz. And we'll go forward.
Good day, everybody, and welcome to Lesson 7, the Ben and Boz narrated PowerPoint series. I'm Boz.
I'm Ben.
How you doing today, man?
I'm feeling good.
Feeling good?
Feeling great, you might say. How are you?
I'm about to record one of these videos. Nothing better than this, man.
You're on a high.
I'm on a high.
All right.
Lesson 7, fixing intangible assets.
I'm excited about it.
I think you're taking this one.
I am taking this one, and it's time.
I'm just going to sit back and relax.
Thank
chime
you.
in with
You can chime
unnecessary
in
comments.
every now and again. Well, I'll keep us on task. We'll be out of here in 3 minutes. I'm just kidding. We will not. Anyway, let's get into it. So, fixed assets, usually pretty large here. So, Boz, can you guess what company this is?
You know, I probably wouldn't have been able to guess it.
How about what type of company? That might be a better question for you.
What type of company? It's got a massive amount of inventory, so I would have gone with a retailer. As an example.
But we're looking at property, plant, equipment. So what does that tell you?
That they have a lot of kind of stores, probably. I'm guessing it's a retailer, so it's someone with a lot of big stores. You know, you always just think when you think retailer, you usually go to Walmart first, so that I might have guessed them just because these numbers are huge, but it's not.
No, because we use Walmart pretty much every time, so
right.
We change it up. But before you figure out what company it is, I just want to highlight some of the different types. When we say fixed assets, there are a lot of different types that we're talking about here. So land, we're not really going to talk about that here. You don't depreciate it. You just buy it.
That's a big one for this company. The
land's never depreciated.
Although a lot of retailers now they're starting to lease
all the rest are.
Where they sell it to receive cash right away, and then they just lease it right back to themselves. So shareholders get the immediate cash, they get the flexibility.
Wow.
Yeah.
Great.
Beyond the scope of this video, you get your bonus right away.
Yeah.
Buildings and improvements, that's pretty major. Equipment, fixtures, construction and process. We're going to talk about that a little bit. It's where they're building their own assets.
CIP.
And then all that's added together for gross property and equipment. Subtract depreciation, which we're going to learn. That's pretty significant to end up with our net.
And gross does not mean disgusting. It just means before any adjustments are made.
We've had so many things that have said gross so far, and I did not make that joke, but.
Just a quick commentary. You'll see here that almost half the assets are fixed assets. So again, pretty significant on this balance sheet. We look here and actually $30.7 billion less 11 billion for a net of almost 20 billion is where we're at. So just taking a quick look.
You know, all right. Thanks for bringing us there.
That just means no adjustment.
All right, everyone. It's not Costco. Oops, not Walmart. It is Costco.
It is Costco.
It's not Walmart. It's Costco.
I love
competitor
Costco.
to Sam's Club. Yeah, I'm a big fan as well.
Costco owns a
I
lot
love
of
listening
buildings.
from Walmart. Nothing against Walmart. All right. So overview. What we're going to do here. 3 main points with the sub point that we're looking at. Number 1, we want you to understand the accounting for property, plant, and equipment. We're going to go through inception, so purchasing or creating an asset. We're going to handle what do you do when you have maintenance, what do you do to depreciate it, basically the ongoing stuff, all the way through the end with disposal.
Inception means creation.
Thank you, Boz.
Just making sure.
You're doing a great job.
All right.
And the biggest piece with this is the 3 main methods of depreciation. That's probably the heart of this lesson, I would say. We're going to briefly touch on how to deplete natural resources. It's similar to depreciation, but just a little bit special, so we'll do a quick slide on that. And then we're going to end with a little bit of a broad accounting of intangible assets, what those are, what that means, and how you work with them in accounting.
Sounds good. Some people listening right now might say, I don't even know what do you mean by an intangible asset. Yeah, stay tuned.
Stay tuned. After this commercial break.
You can touch things you can't touch.
Stay tuned with us.
Piece of paper.
We can cut that out, right?
No, we're leaving that. Yeah.
All right. You know, that's fine. That's all right. You got to be vulnerable sometimes.
That makes you look silly.
That's fine. Hey, whatever makes you look good. All right with that. All right. So let's start with the acquisition, property, plant, and equipment. Again, it's commonly referred to as plant and equipment as your fixed assets. So some examples of property, plant, and equipment: land, office buildings, factories, machinery, vehicles, computers. What else you got to add, Boz?
Those are normally just, what I think of. It's, what does a company need in order to produce stuff is what I usually think about. They need a plot of land, a building, and then machinery and computers and stuff like that inside.
And something that's going to last for more than a year, usually.
Yep, exactly.
More than a year.
And then how do companies acquire? We're looking at 2 different ways. By far, the most common one is buying from another company. But as we saw with Costco, they can also construct their own assets. That'd be Costco building their own stores, probably building some warehouses, things like that.
Exactly.
All right, so
software too.
One thing we want to set out for its own is the difference between capitalizing and expensing and what that actually means. So when we capitalize something, that's when we actually create an asset. We're saying, okay, we're going to use this, whatever it is, this factory building as an example. We're going to use it for more than 1 year. So we're going to go ahead and capitalize it, put it on our books as an asset, and then we're going to record the expense a little bit every single year as we use up that cost.
Sometimes think of capital assets more as long-term investments, if it helps.
Yeah. So, and then the alternative to that, outside of capitalizing, we could expense it. And when we expense it, it goes right to the income statement. It's going to reduce our net income, which companies might not be super excited about.
We'll talk about that in a bit.
Now that's a good teaser.
Yeah.
Stay tuned, everyone.
Right.
All right. So say we're going to capitalize something. We find an asset that we purchase. We know that we're going to use it for the next few years, and we decide, all right, we need to capitalize it. Well, what can we actually include in that capitalization? So a couple of examples. I was trying to think of a question to stump you a little bit as we went, but nothing popped off the top of my head. So
It's not easy to stump me. I was just saying it's not hard to stump me. So.
It's not just the purchase price that we're looking at here. You can also include sales tax, legal fees, transportation costs, setup. The bigger picture here, anything to get the asset ready for its intended use. So
simple thing, like if I purchase a computer for $1,000, but there's 7% tax on that, $70. I pay Amazon $20 to ship it to me. Then I have to record the 1,000 plus the 70 plus the 20. All of those would be included as my asset. I wouldn't, expense the shipping cost of $70. I wouldn't expense the shipping cost of $20 and the tax of $70. They would be lumped in with the asset.
Yeah, and that is pretty common. I ran into this a lot with companies purchasing equipment in particular, where if they're purchasing equipment, but then they're heavily modifying it for their own manufacturing process, they have a lot of additional costs to get it ready for use that they end up capitalizing and expensing over time. So that's if an asset is purchased, but what if the asset is constructed? So if we're going to build our own asset, then we just capitalize anything that we had to spend in order to do it. Usually material is going to be a small piece, labor is going to be the biggest piece. And just an interesting little tidbit here, if you take out a loan to finance the construction of your building, any interest that you have on that loan while you're building the building, you can capitalize that.
Yeah, we're going to get into journal
interest.
entries in a bit, but what that means is that you pay $100 of interest on a loan to build a building as an example. You wouldn't debit interest expense for $100, you'd debit the building asset for $100.
Yeah, and on the other hand, if you purchase something, you take out a loan to buy that same building, but you're purchasing it already constructed, you do not get to capitalize the interest cost. Whoa. Do you know why that is?
Do I know why that is? Do you know why it is?
I'm just trying to stump you.
I guess I can think about it a little bit. So, but I think it's probably because you're purchasing the asset when it's already completed in that second situation versus the first one. It's really building it throughout the process.
I would think the seller would probably already include their interest costs in that price that they sell to you, so it's already thought it was being paid for.
I was kind of thinking that. You articulated it better.
But I said it.
You did. So. You did much better. Ben is better. So.
I actually have a recording of a bot saying that from the summer. When I'm having a rough day, I just play that on a loop.
That's right.
Anyway, all right, so what are journal entries with this process? So first we're going to look at when an asset is purchased, and when we purchase it, we are going to debit whatever fixed asset account it is, and then our credit is generally going to be to cash or to notes payable. So what does that look like? Debit to factory, assuming we paid $1 million for a factory, and then we credit notes payable for $1 million.
Or a mortgage payable.
Nothing to add to that.
Thank you. Pretty straightforward. It's nice when you know exactly what the dollar amount is.
If you paid cash instead, you credit cash there.
Yes, thank you. That is correct. You could even get a little tricky with maybe it's like mortgage payable.
Whoa.
Payable. More specific with the note. Usually don't see companies doing that though.
Not as much. I agree with the notes payable. I like it.
All right. So
what if the asset is constructed, Ben?
Thanks for keying that. Do you want me to let you talk a little more?
No, this is like yours.
All right. So when an asset is constructed, it gets a little bit more complicated. So throughout the construction, anytime that usually it's probably gonna be around financial reporting dates, we're going to record any progress by debiting an account called construction in progress and crediting cash or notes payable. In this case, the first one, it was $400K, happened again for $600K. Now I'm saying it's done, right? We've debited construction in process, credited cash and notes payable, but it's no longer in progress, ready to move in and start setting up. So when construction is completed, we debit factory and credit construction process. So you can see this construction in progress account, we set it up with a debit balance, and then when we're done with it, we credit all of it and just move it to one of our traditional fixed asset categories.
I think we could call that a temporary account.
You could. Yeah. Nominal.
Nominal.
All right. So those entries kind of cover the setup. The initial, we're ready to go, we have our asset on our books, but now we're going to use it throughout the years, hopefully longer term, and we're going to talk about depreciation. So one key with depreciation that I hear students struggle with almost every year is that we are allocating the cost of the asset over the useful life. We are not measuring the value of the asset. This is something completely different. Some assets, maybe if it's land, that's going to go up in value. Other assets, maybe if it's like a truck or a car, that's going to go down in value. We're not trying to measure that value. We're just allocating the cost. We're saying, here's what we paid for it, and we want to allocate the total amount that we paid for it over every single year that we're going to use it.
Yeah, it's a limitation of accounting that accounting does not show fair value with many assets, but a lot of that would just be too subjective, and that would just really create too much judgment, I think, is what would happen.
Yeah, absolutely.
So here's our attendance question for the day. Market value versus book value. If you fully depreciate an asset, you buy a car for 20 grand, and after 5 years, it's on the books for 0 grand. Is that the market value of your car or vehicle as well? Go ahead and chat, put a yes or no or other if you choose, and let me know what you think. Okay. So you're right. Chances are you got a car that still runs 5 years later. Maybe it's got 75, 100,000 miles on it. It's probably not worth 0. So it's something that will be on the books. It'll be on the books for 0. A building might be fully depreciated after 40 years, but chances are the building is not worth 0. Especially downtown Florence now has come back a long way. The same thing in Charlotte. Same thing in Charleston. Same thing in New York City. You fully depreciated building after 40, 50 years, chances are you're on Fifth Avenue, it's not worth zip. Okay. And you're right, it better not be. Good answers. Thank you.
Right. So in order to actually record a depreciation, we need to know 3 different pieces. 1, what is the cost? We talked about that, all the different things that you can include in the cost. 2, how long do we think we are going to use it? What is a useful life to us?
Maybe we buy a car, we say we're gonna use it for 5 years.
Yeah, and actually you saw at a trucking company and they would say about 5 years on their trucks.
Nice.
They call them tractors and trailers.
I know.
So the tractor trailer. There you go. Getting outside, just this.
First time I ever heard the phrase tractor trailer, I was working in Pittsburgh actually, and they talked about tractor trailers creating jam ups on the freeway, and I thought that like Farmer Johnson had his tractor out there, but no,
But
this
no,
was a
alas,
semi.
no, it's a
so
semi.
I felt silly that day. So
really?
they told me about that.
Well, then you learn. You still remember. All right. So not only do we need to know the useful life, we also have to estimate the salvage value. And what salvage value is, that's where, say we're done using that truck, can we resell it for something? Are we going to run it into the ground? Can we scrap it for parts? What can we do at the end of the useful life for us?
I don't know about you. I've seen most companies, it seems like they estimate 0 for the salvage value. Basically, they're going to scrap it for nothing or no material amount at the end of the use.
Basically don't anticipate they're going to have any value left in it. And so notice number 2 and 3, those are both estimates. Companies don't know that. They're going to take their best guess, and usually they're going to set up a policy. So all trucks will be 5 years.
These
So
are
all
our
tractor
guesses.
trailers will be 5 years. All buildings will be 30 years.
That's right.
They'll set up predetermined amounts. And then, okay, so we know those 3 pieces of information. Then we know there are 3 different ways to measure depreciation. 1, straight line. The vast majority of companies do this. Same amount of depreciation every single year. Number 2, units of production. They try and match it to however much their asset is going to be used. So that truck, for example, if you drive more miles in 1 year, more depreciation that year. If you drive fewer miles, then it's less depreciation. And then declining balance, where it allows companies.
I'll mention here with declining balance, you do not take into account a salvage value. So if we're looking at that, no salvage value accounted for with declining balance. Okay, so you do not use that in the calculation. You might be going down to a certain level of salvage value, but you don't use that in the actual calculation of initial depreciation with those declining balance methods. We'll talk more about that in a little bit. All right.
Needs to take extra depreciation right away. The thought being that the value of the asset is going to decrease over time.
Which one would you say they use the most?
Straight line, 95% of the time.
Thank you for the bank, 95%. Let's start with that as an example, and I think the most important.
That is a great idea. Why don't you talk us through this first part?
Good segue. You want me to do straight line? I think I can handle this one. So
Yeah, you do straight line. I'll do units of production. You can do declining because that leads into tax.
Whoa,
Eventually.
I like to talk about tax. So, well, straight line depreciation. So Ben just commented that we have to know cost, estimated life, and salvage value. So let's say that we got Costco purchasing a forklift, cost of 100 grand. They're going to use it for 5 years, and then contrary to what we said, they're going to have salvage value at the end. It
makes a better example.
It does make a better example. So of $10,000. So then we have to compute depreciation expense per year, and the 100,000 minus the 10,000. That numerator simplifies down to 90,000. 90,000 is the amount that we're going to depreciate over 5 years. So that'll result in 18 grand of depreciation expense per year.
So we can use this formula every single time?
Every single
Time
time
we
that
do
we do
straight line
straight line depreciation. Yeah.
Dollars per year.
Cost minus salvage value. What are you going to expense over the life of it divided by the life?
Whenever you say like every single time, it makes me wonder if there's an exception.
I know.
It makes me nervous.
It
I
always
don't
makes
know.
me nervous when it's every time.
Every time, Ben? Every
Yeah.
time?
No, that wasn't my intent.
That's
No,
right, okay.
it is every
I
time.
think pretty much every time, yeah.
Okay.
So now the journal entry for year one and the financial statement.
That's what I
impact.
really care about.
You care about journal entries.
No, financial statement
Financial
impact.
statement
Yeah.
impact. So the debit goes to depreciation expense, and the credit goes to accumulated depreciation. We would have learned this one, I think, back in lesson 4 is when we introduced
Yeah, but
this
could you
concept.
remind me?
Could I remind you?
Just for the sake of the video.
Well, what?
No, actually for my own sake.
For your own sake. So
It's been a long day.
Yeah, that's true. But depreciation expense, we debit that. That is just the expense associated with kind of the using up of fixed assets. And then the credit goes to accumulated depreciation, and not in this situation, forklift or equipment. And that is because when we get done using this asset, we're still going to have that forklift. So, you think of supplies, when you use those up, you actually credit the supplies account, because when your Post-it notes are gone, they're gone. When you have fully depreciated your forklift, for example, it's still going to be sitting there. It's probably going to be in pretty rough shape, but it's still sitting there. So that's why they use accumulated depreciation, which I would refer to as a contra asset.
That was a great. I haven't thought of that supplies analogy before. That's a good
Contra
one.
asset
Okay, I
account,
like it.
credit balance on the asset side.
Always learning from
That's
you.
right.
Always learning from you.
And then, and then year one, go back. I didn't say go forward yet. So in year one, we've got depreciation expense. And I just wanted to show on the bottom right-hand corner of that balance sheet, the forklift of 100,000. Then we've got the accumulated depreciation, and then we'll show the net balance of the forklift.
Net
at
book
80,000.
And
value,
most companies will actually
NBV, you're
just
going to want
show
to know
net
about
property,
that.
plant, and equipment. I had to search a little bit to find Costco.
Yeah.
That would break out the actual specific types of assets, and then the
Usually on the balance sheet, it's probably net, right? And then the footnotes, they will show gross, and then like the accumulated depreciation, and then get down to net.
We're feeling a little chippy tonight. I kind of like it. A
I
little
think so.
edgy on lesson 8.
Pretty much.
Lesson 7.
Lesson 7.
Lesson 7.
That's right.
All right. What happens in years 2 through 5?
Pretty much the same thing from a journal entry standpoint.
Identical,
we just continue to have
year
depreciation
2,
expense and
year
accumulated
3,
depreciation. We'll do that all
year
5 years,
4.
and then really the only change is on the balance sheet.
keep
You notice that the
accumulating.
forklift balance of 100,000 doesn't change, but the accumulated depreciation just keeps getting 18 grand higher per year. So at the end of year 2, accumulated depreciation will be 36 grand. At the end of year 3, 54 grand. Year 4, 72 grand. And at the end of year 5, it will be $90,000 there in the bottom right-hand corner.
I can keep up with your mental math, but
You've
yes, that
probably
is
been able to
correct.
count by 18s in my head.
We'll see how it add up by 20 and subtract 2.
Net
What you're just
book
going
value
boom,
of 10 grand after 5 years.
So,
18, yeah,
Oh, that
20,
matches your
38.
salvage value.
Right? And then you
It
subtract
is.
2 from that
Well, I could
to
do
add it
that,
for 18,
yeah.
yeah.
Accumulated depreciation increases, that'll decrease the net value of the asset on the balance sheet.
Cool.
That was exciting. Thanks for letting me do straight line
You're
depreciation,
welcome.
man.
I want to take it back though for units of
Take it
production.
back. You take this one.
All right, thank you. So we have the same situation here. Costco purchased a forklift for 100 grand. Salvage value is 10 grand. The big change in this one is that the estimated life, instead of saying 5 years, we put it by 15,000 machine hours or 15,000 engine hours. I don't know if you knew that, but that's actually how they measure the productive capacity of a forklift. How long are they going to be running the engine? And so
Like an aircraft
what we're
engine.
doing under units of production is we're trying to match our depreciation expense each year into how much we actually use that forklift. So if we were to look at this, our formula changes a little bit where we have cost minus salvage value. That's good. Over useful life in units is the key. Before it was useful life in years. Now we're in units. So if we apply that to our situation here, $100,000 minus 10,000 tells me I need to depreciate 90,000 total, and I'm going to depreciate it over, my best guess is 15,000 hours. So that comes out to every hour that I use this machine, I should record a journal entry for $6.
I don't know if you would do it every hour, but
You would not.
At
You
the
would
end of
not
every
do it every
period,
hour.
you just count. You just basically, in reality, you'd probably call up someone in the plant, right? Basically, and how many hours does that forklift run? And if
They actually have counters in these. Did you know that?
I suppose counters. I suppose the good ones would feed right back to like corporate and accounting folks, wouldn't they? So
Yeah, if you wanted to.
it'd be nice.
Anyway,
Doing a
so what
truck,
is our
it could
journal
be
entry in year
dollars
one,
per
assuming
mile.
we use the forklift for 4,000 hours? So straight line, we didn't need to know how long we used or anything like that. It was just year one, right? We're ready to go every single year. With units of production, we need to know each year how many hours was it used. So the actual account's going to be the exact same, just the way we calculate the amount is going to change a little bit. So 4,000 hours at $6 of depreciation per hour. So 4,000 times 6, Boz?
That's 24,000.
It's
I
because
love
the answer
math.
was in front of you, wasn't it?
It was. I could have done that. I wouldn't have needed to like add 20 minus 2 like you would have done or whatever.
I don't know how that would even work on this one. But-
Wouldn't have.
so debit depreciation expense, credit accumulated depreciation for the 24,000.
The
and
debit
then-
and credit doesn't change. Yeah, it's just the amount that changes.
The amount changes, and as you can see, depreciation expense still hits our income statement, so we're reducing our income by 24. And then on the balance sheet, same accounts, forklift and accumulated depreciation for that forklift, so we have a net value of 76. So
In theory, I look at this one. This probably is more accurate than straight line, right? Yet you said 95% of companies use straight line. Any thought why that is? I'm just,
yeah, so I think what the companies would say is that when we do this, we have to get one more input every single year versus when they do straight line, they just set it up in a lot of their fixed asset systems
Set
and
it
it runs
and forget it.
automatically.
simplicity, materiality.
And so, yeah, as an auditor, I would come at it and say, hey, you know, before you said it was 18,000, under this method it'd be 24, so we're off by 6 grand. You know,
And this is Costco with 20 billion of net fixed assets.
they come back and
so-
say that's immaterial.
Yeah,
We're not
sometimes it
gonna
might
worry
be
about
6 grand high, sometimes 6 grand low, you know. So, well, it's more, more refined and accurate, perhaps. It's just, it would take more time.
Just wait till the summer slide.
Ooh, I can't wait.
Yes. All right. So,
We're here.
what happens year by year then in the summary? You can see each year here, we are recording the hours that we use the machine. Depreciation rate does not stay the same. We set it at 6 right away, so it does not change. It
It
stays,
does not say the same.
I'm just thinking ahead.
Wonder
yeah.
where you're going with that
It
one.
does not change.
It does not
I misspoke.
change.
Yeah, it stays the same at
Okay.
6 each time. So our depreciation expense is always going to be the hours that we use it that year times the rate of 6 gives us our expense, and then accumulated depreciation just adds up each year.
Works out perfectly this way, doesn't it?
You know what?
What?
What if things don't work out exactly as we planned?
So I'm going to say that if we estimate when we buy a forklift that it's going to run for 15,000 hours, I'm just going to speculate that it's not going to run for exactly 15,000 hours.
Probably
So
not,
We might be
probably
off
not.
by an hour or two with that estimate.
At least one or
At least one or
two.
two.
So what happens in that case is we're just going to take our last year and adjust it to meet whatever our expected salvage value was. So let's change the scenario. You see up here they're each going down by
Plug
500
last
hours used.
year.
But now I change it so this year 4 we had 3,000 and then the last year is 2,500. As you can see, if we would take full depreciation 2,500 hours at $6 per hour, that comes out to 15 grand of depreciation expense in the last year, which would put our accumulated depreciation all the way up to 96,000. So that was higher than we thought it was going to be, but that was only going to be 90. And so if we still think the salvage value is 10,000, so 100,000 minus the 10,000 salvage value would just mean accumulated depreciation should be 90. We would cheat almost this last year so that our ending accumulated depreciation comes out to be 90.
Yeah, I mean, it's a good point. If we actually used it more, maybe our salvage value would truly be
Have to
lower.
do
You know,
that
just
with
kinda
our
leave it as is, not make the
accelerated
adjustment.
method,
But
our
we still
declining
get that same
balance
salvage
method
value.
as well.
Make the adjustment you just noted.
Probably just another reason companies use straight line too. They don't
think
have to
so.
think about that or analyze it every year.
point.
All right, declining balance. So I'll introduce this one, but I know you want to talk about it.
Declining balance.
'Cause it's closer to tax.
It's closer to tax. Yeah, that's true. So let's go with the same facts here. So Costco purchasing the forklift for 100 grand, 5-year estimated life, 10,000 salvage value, but they're going to use a double declining balance method, which we have to do in this situation. Our formula is we have our depreciation rate, and we do that equals then 1 over the useful life multiplied by 2, because we're using double declining balance. Had we been using, some companies use 150% declining balance, and then we would have multiplied it by 1.5. So what we're doing there,
That first part of the equation, that's really similar to straight line, isn't it?
that it would be the same as straight line, basically,
Exactly.
just another way to look at it. So as opposed to depreciating a fifth each year, we're going to multiply that by 2 and depreciate 40% each year. Of the
You can do
carrying
fractions
value.
and percents, everyone, not just
I can.
integers.
So we use the phrase, we're going to depreciate 40% of the carrying value each year. Sometimes we'll refer to that as net book value, but carrying value or net book value, that is the cost of the asset less the accumulated depreciation.
So again, and we can do double declining balance. We can do triple declining balance. We can do 150% or 1.5 of the declining balance. This case is double the rate. So if it was a 10-year depreciation, instead of 10% a year, you do 20% the first year, and then 20% on the remaining balance, not the original amount, but the remaining balance, so it keeps decreasing. So in the early years, you get a whole bunch more depreciation. In the later years, you get less. In this case, we're doing 5-year, which is a 20% a year normally. We're going to do a double, 40%. And something called makers I want to bring your attention to. Modified accelerated cost recovery system. This is what the IRS uses. Okay. So modified accelerated cost recovery system. Impress your friends on a Saturday night. Makers is the acronym that the IRS has created, and for tax purposes, they require using makers depreciation, which is a declining balance. Most of the time it's double declining balance. Sometimes it's 150% declining balance. And they have a convention. We actually talked about it last class. They usually use something called a mid-year convention. What the heck's a mid-year convention? It's not a conference. It's not a party. It's not something we go to an activity. It's a standard that's used so that you don't have to worry about if I buy something on July 1, do I take 6 months of depreciation? Well, straight line, we would. If I buy it on January 31st, we take 11 months depreciation. If I bought it on December 1st, we take 1 month's worth of depreciation. But instead of worrying about calculating the number of days or the number of months or the number of quarters you own an asset, they usually use a mid-year convention where the first year they take a half year's depreciation, and the last year they take a half year depreciation. So how does that work? So a 5-year asset, half year in the first year, they do 4 more years of full year depreciation. So that's up to 4.5 years. And in the 6th year, so half plus 4 more, that's 5 years worth. They take another half year's depreciation in the 6th year. Just makes it easier. So you can buy it in December, you can buy it in January. You'll take a half year's depreciation no matter when you get it. You don't have to mess with it. The catch here, though, is you may start having your books per GAAP be different from your books per IRS. Nothing requires you to have one set of books in a company. You can have 20 sets of books and be perfectly legal. You got fair market value books. Yeah, we're talking historical cost. We mentioned that with fixed assets and buying a building. It might be worth more as a market value than it shows on the books. It might be fully depreciated to 0. So we can have multiple sets of books, but I just want to point out that the accelerated depreciation method using declining balance, bottom line, you do some more depreciation in the early years and less in the later years. And let's go ahead, keep it on.
So we go to year 1 then, and we'll do the journal entry and the financial statement impact. And the carrying value at the start is $100,000. We don't reduce that by the salvage value yet. We'll eventually get that into play.
But for now, we just ignore it right away.
Yep, just carrying value cost less depreciation.
Still
Cost is
depreciation.
$100,000. Accumulated depreciation is 0.
40,000 instead of 20.
Multiply it by 40%. We have 40 grand of depreciation in year 1. That's our expense, and that's our accumulated depreciation. And then similarly, in the balance sheet, we have 40 grand of accumulated depreciation and 60 grand of net book value, which is now also going to be considered our carrying value.
Were you trying to keep me up so that we say it at the same time?
Well, I did. You didn't.
I tried again.
And now we get our 60 grand, which would be our
carrying value.
Oh,
I rushed it.
Anyway, don't deduct salvage value
keep
here.
ourselves amused here. So then we go to
hopefully keep you guys amused too.
Hopefully. So go to that. You'll go to our next summary schedule here in year 2. Our carrying value is 60 grand. 40% depreciation is 24,000. Accumulated depreciation is 64 grand. Year 3, our carrying value is 36 grand. 100,000 cost minus the 64,000 of accumulated depreciation. We multiply that by 40% to get our depreciation, and our new accumulated depreciation is 78,400. This is why you want to do it.
It looks to me like depreciation expense is declining.
It's shocking.
Year over year, isn't it?
It is. It's the declining balance method.
Huh.
Declining.
Oh.
So crazy. Huh?
More
depreciation up front. So year 4, 21,600 multiplied by 40% is 8,640 of depreciation expense, $87,040 of accumulated depreciation, which leaves us a carrying value of 12,960. Now, if we multiply that by 40%, we get the depreciation expense, and we get accumulated depreciation of 92,000 and some change. The issue with that, and go once more here, is that now we have more than 90 grand of depreciation. And remember, we said our salvage value is 10,000, so we can't have accumulated depreciation of more than 90,000. So in that final year, or in whatever year here that you go above, your accumulated depreciation would get too high, meaning that you would be kind of over your salvage value.
Sometimes
you just make an adjustment to
year,
cap it off, and in this situation, cap it off at 90 grand, so that we still have our 10 grand of salvage value.
Yeah.
You want to do that slide? That's
actually, I was not even going to read all those. I go through 1 and 2, and then you see the pattern. We can move on. But
that's true. So, but summary slide, we just got it right. Oh, you want to do the summary? This is the summary.
Yeah, so it's all good. It's all good. We'll be all right. So what's cool about this is that you can see side by side, we have the exact same total depreciation over the 5 years. Doesn't matter if we use straight line, units of production, or declining balance. It is the exact same total amount over time. So straight line evens out. I think companies also appreciate that they can anticipate what that expense is going to be if they're trying to predict earnings per
Straight
share.
line's
They have a
pretty
little bit of
straightforward.
insight into depreciation expense. Units of production, you're not really sure
more
exactly what it's going to
accurate.
be. And then
Units of
declining
production.
balance, you take a big hit right away, which might not be so good for earnings per share. But in those later years, you don't take as much of a hit. So
Exactly. So now what do you choose, right? And then
this is Boz's slide. I
this is my
can't.
slide.
Yeah.
And by the way, you're taking a different method of depreciation, a declining balance method, accelerated depreciation method can be justified because the car you buy this year isn't going to have a lot of maintenance. You're not going to need new tires, new battery, new stuff to maintain it, new brakes. But as cars get older, as machines get older, they do take more maintenance. So it's easy to justify an accelerated method. And even if you drive a car off the lot, first mile, typically you lose 10%.
But, a goal of financial accounting, we think about this when we want to give useful information to people, so we want to be useful, but at the same time, companies keep in mind materiality, simplicity, and the fact that they like to show high net income, such that I think they usually choose straight line because of all of those factors that we just listed. Now, for tax purposes, they've got their own different set of rules, and for tangible assets other than buildings and land, and maybe like landscaping or something, but companies generally can deduct 100% of the cost of the asset in the year purchase. And
is that new tax law stuff?
Well, it's kind of been, the simple answer is yes, that's now in place with the new tax law. There's been some rules historically that have allowed you to do that from time to time, so it kind of changes every year. But so companies, it's interesting. A company could show financial statement income, but not pay any tax. That tends to tick off the public. So they see profitable companies that don't pay tax, but it's because they can take full depreciation expense for tax purposes in year one, and they like to do that because then they don't pay any
Save taxes.
So when we were talking about inventory, we said a company has to choose LIFO or FIFO, and they do both for tax and book. But here for depreciation, you can have a different method for tax than you do for book.
Yep, exactly. That's what they do.
Cool.
Straight line for book, and then special method for tax purposes.
Yeah, I'm glad you put that in there.
Small businesses
Happy to
are
add
the
in that
same.
comment.
All right, so during use, by far the biggest piece is depreciation. That's happening every year. But there are also going to be periodic repairs, maintenance, and also potentially some additions or improvements. Maybe you expand your plant, and so you can store more, right? You add a warehouse on your factory, something like that. So for repairs and maintenance, we're talking about any sort of routine cost to make sure our assets are still in proper condition. I get an oil change in my car, right? That would be maintenance, I would say. Key with these, they do not extend the useful life of the asset or increase its value. You kind of just got to do it to keep it going. Additions or improvements, on the other hand, these are referred to as capital expenditures, to get in some technical terms here. And so with capital expenditures, we're talking any sort of significant expenditure that's going to increase the life or value of the asset. Maybe if, like I said before, I add on to my factory building, or maybe in my truck that I was using for Costco, I put in a brand new engine so I can keep using that truck for the next 10 years or something. What else are you going to say?
Well, that's what I was going to say, that one. So now
getting snippy.
Getting snippy, that's right. So,
I like it. It's more fun that way, a little edgy. So want me to move on?
Sure.
I'm about to key you up here.
Okay.
All right. So when we use big examples like that, an oil change versus a brand new engine in a truck, it's pretty straightforward. It's not that hard, but it is not always clear. And a lot of times you do have to use judgment. And the reason for that is the company itself, they have an incentive to capitalize their expenditures. So if I'm looking at something, I can take a big hit right away.
So let's talk about that for a second. When we did the fraud chapter, you recall a company called WorldCom, and instead of expensing long distance charges, they capitalized them. So instead of having lower net income in the current year, they had a smaller expense. They put it up on an asset, and they depreciated over 10 years. Well, by moving the expense to an asset, you reduce the expense, increase net income, and then you're able to allocate that asset over a longer time period. The only problem was that was a lie. The long distance charges related to current year's long distance service provided. So they really weren't supposed to capitalize. This was a case of billions of dollars taken off the income statement as an expense and moved up to the balance sheet as an asset. And they got caught, and they had all kinds of headaches and hassle, and they closed the doors. They sold off.
Big expense on my income statement, or I could put it on my balance sheet and spread that out over time.
So you're incentivized to get it off the income statement.
It does. It can be a problem though because you're just deferring the expenses. So, but
has it ever been a big problem before?
It has, and I guess we'll go right to it. So in 2001, 2002, WorldCom spent $3.8 billion that it should have expensed. It was for items that were more having a current benefit for the company, but instead they capitalized them and they actually inflated their income by $3.8 billion. Then after this unraveled, WorldCom declared bankruptcy. The auditors Arthur Anderson ended up going out of business for their WorldCom and also the Enron scandal as well. But this one for public companies, this is a really sensitive issue. Public companies are under a lot of pressure to produce earnings, and this is an area that if you have unethical, chief executives, that they can decide to try to push things here a little bit and record assets when they should record expenses.
There you go. You heard it from the ethics expert, Boz Bostrom.
I appreciate the shout out, man.
I mean, though. All right. So what do these journal entries look like? If we have, say, maintenance expense, we're going to debit maintenance expense, probably credit cash for something small like that, maybe accounts payable, usually cash. If it's an addition or an improvement, we're going to debit a factory or whatever a fixed asset is and credit the cash. So that's kind of takes us through We started with what do we actually capitalize for an asset, then we went into during the use. Now we're going to go at the end, the disposition, so we are getting rid of all of our fixed assets.
We say disposition, it could be a sale, oftentimes it's just scrap it as well, so give it to the junkyard.
Yeah, breaks down. Sometimes it just costs you money. You don't get any payment for it. But in our example here, a company's going to sell a building that had a cost of $100,000, accumulated depreciation of 70, and they received $25,000 in cash. So we want to figure out what is the gain or loss on this transaction and what is the journal entry.
And to compute that gain or loss, you got to look at the proceeds, which in this case are $25,000. Subtract off the net book value, which is $100,000 of cost, less accumulated depreciation of 70.
Net
And in this
book
situation,
value.
we would have a loss of $5,000. Probably should have put some brackets around that one. So
I was getting all excited to cheer for a gain, but we ended up with the loss. So.
$5,000 of a loss.
But you can see it right here.
Yeah.
Proceeds are 25. We had it on our books for 30. So obviously the proceeds are less than what we had it for. So we got to take a loss for 5K on that.
Yep.
So then getting into the journal entry, well, what do we know? We know we got cash for 25,000. So debit our cash for 25,000. We know we had accumulated depreciation of 70. That normally has a credit balance, so we need to remove it, right? We got to get rid of that. So if it had credit, we need to debit accumulated depreciation to get rid of it. We have a loss. Losses are like expenses, so we're going to debit the loss for 5,000. And then finally, we have to get rid of this building that had a debit balance of 100. We need to credit it to get rid of the building, take it off our books, cancel it out, if you will, in your mind. So credit the building for 100,000. Yeah.
I do this a little differently. I like to do a journal entry right away. I know I debit my cash because I received the monies. We take it, cash in the door, 25 grand. Thank you very much. We have to clear the credit balance of accumulated depreciation by debiting it. And then we have to remove the building, which is a $100,000 asset debit balance, by crediting. And what do? I like to plug my gain or loss. My gain or loss washes out once I know 3 items on my journal entry. The 4th item is obvious. And if it's debited, it's a loss. It's like an expense. If it's credited, it's a gain. It's like a revenue. So I prefer doing a journal entry to determine gain and loss. But if you want to jump to net book value and cash proceeds and then calculate the difference, that works just as well. Let's go ahead and keep it on. I apologize for getting it caught up in.
You were 35 minutes in.
Let's go here. We're almost done here. Okay, so there's our, we'll continue onward and upward.
But it normally has a credit balance, so we need to remove it, right? We got to get rid of that. So if it had credit, we need to debit accumulated depreciation to get rid of it. We have a loss. Losses are like expenses, so we're going to debit the loss for 5,000. And then finally, we have to get rid of this building that had a debit balance of 100. We need to credit it to get rid of the building, take it off our books, cancel it out, if you will, in your mind. So credit the building for 100,000.
Yeah. So that's an example where we had a loss, and then the next slide is just an example where we have a gain. So same exact thing, except there is cash that the company received here of 45,000. Woohoo!
Getting rich.
That's right. Instead of the previous slide, 25,000. So proceeds 45 grand, net book value is still 30. So now we have a gain of 15,000. The journal entry is structured largely the same with one exception. We still debit our cash, but this time it's for 45 grand. We still debit our accumulated depreciation for the 70 grand. But this time instead we're going to instead of debiting a loss of 5 grand, we're going to credit the gain of 15. Woohoo! And credit the building of $100,000.
So then we're going to plug the 15,000.
Usually companies do have a loss though on retirement. That's okay. Or they're fully depreciated.
That's true.
And there's really no entry.
That's true.
All right. So one quick example here with depletion. This isn't super common, but oftentimes or sometimes companies use natural resources. So they record depletion. That's the term that we use when referring to natural resources. Depreciation is fixed assets. Depletion is natural resources. So we would record that using units of production. So say a company purchased a tract of timber for $900,000 with an estimated 2 million board feet. And yes, I did look that up. That's how you measure it. The land will be worth 50K after the timber is harvested. So what is the journal entry here? Well, first thing we look at, what is our cost per board foot? This is our rate, similar to units of production. The cost of the asset was 900K, minus our residual value of 50K, meaning we have $850,000 that we're going to deplete.
Could be
divided by the
tons
life
of copper,
2 million board feet. So
iron ore.
850,000 divided by 2 million gives us 42.5 cents per board foot. So the journal entry then, in year one, we have an expense of 100,000 board feet that we harvested at 42.5 cents each for 42,500 total. And that leads to depletion expense is debited and accumulated depletion is credited.
I have nothing to add.
Yeah, it's not that common and it's fairly straightforward. So if you know units of production, you'll be pretty good. Let's move on to intangibles. You have a lot to add there. You do a lot of work with intangibles.
I do look at intangible assets a lot. So when I think of intangibles, I'm just thinking of assets that aren't physical. They have no tangible.
Basically a piece of paper, a right to
indefinite lived
something.
intangibles, and they're going to be created when one company acquires another. That's when you normally are going to see these. In theory, you could acquire a trademark from
goodwill.
another company, but it's usually when you have an acquisition of one company to another. And then the examples of the indefinite live intangibles, goodwill is the prime example, but trademarks or brands, a trade name, that's just Coca-Cola. That's the Coca-Cola trademark.
Well,
That would be an example. It's
the
the
Nike
Coca-Cola name is
swoosh.
not going anywhere. It doesn't get used up over time.
And so Coca-Cola doesn't have any value on that trademark within their own company because they developed it themselves. But if, say, Pepsi were to buy Coca-Cola, it's not going to happen, but say they were going to, then they would assign some value of that purchase to the Coca-Cola trademark, and that would be an intangible asset.
Yep, exactly. So, and then you do not amortize these. So you basically just have to check for impairment each year. And what that means is just what is the value of these intangible assets, what profits and cash flows you expect to get from them. And if it's greater than the value of the intangibles on your books, you don't do anything. But if the value you compute of the intangibles is less than their carrying value, then you have some sort of impairment charge.
Expense.
So when we say amortize here,
impact on the
amortizing is
income
the same
statement.
thing as depreciation, except for it's a special term for intangible assets. So you depreciate a fixed asset, you amortize an intangible asset. So definite live intangibles, these are things that do expire. So some examples, patents, copyrights, franchises, licenses, things like that, where you can't touch a patent, right? Patent, the right to produce something using a certain method. You can't touch that. That's intangible. There's a piece of paper that says you have that right, but the actual right, you can't touch it. And so what we're going to do is record amortization on these items to allocate that value.
And your
over
amortized
so,
intangibles
amortize,
is
there's no separate
appreciate
methods or anything like that. You just use
tangibles.
straight line.
No units of production.
No
declining
use,
balance.
no declining balance, no anything. So as a simple example here, company developed a patent, has a 20-year life, and they capitalize it at a cost of $50,000. So what is the amortization entry? Well, we know $50,000 per year, or $50,000 total over 20 years gives us $2,500 in amortization expense per year. Could you have done that, mental math?
I could have, yes.
Good.
I like mental math. Could you have?
Yeah, I would have doubled the 100, divided by 20 to get 5, and then cut the 5
So
in
we
half
have
to get
depreciation
25.
expense, we have
Think how many more
amortization
mental math
expense.
computations I do in my head than you do.
And
Yeah,
there's
you
no
do.
such thing as
So debit
accumulated
amortization expense, credit the patent,
amortization. You
and
go
there you
directly
go.
to the patent.
These are huge issues for companies that
Directly
do
to the
mergers and
intangible.
acquisitions. So that you don't see those a lot, mergers and acquisitions, but when you do, it introduces.
You don't have
a cumulative
accumulated
assets. Because I think if you develop a patent
amortization
internally, it's kind of the
patent.
cost of what you put into that, but all of a sudden you have an acquisition standpoint, and that patent is quite possibly going to be worth a lot more. So it
Marking
becomes-
everything up to fair value is part of the
so it becomes a huge issue.
All right, we've done a lot, haven't we?
We have. So it was a fun session.
It was
We're
fun.
on
I enjoyed it.
territory.
Some of the key takeaways here. So, what do we capitalize? Any cost to bring the asset to its intended use. After it is with its intended use, we want you to depreciate or know how to depreciate using 3 methods: straight line, units of production, or declining balance. After that, we got a little bit into natural resources, so we're going to deplete them, and that's just very similar to units of production. Our indefinite live intangibles, well, we talked about what they are and how we test them for impairment annually, and then our definite live intangibles are amortized each year. So, a lot of different things, but hopefully you enjoyed it, got some out of this video. Thank you guys for tuning in again. Appreciate it.
Any comments or questions? I'll do a quick stop share, take a pulse. We doing all right? Making sense? All right, let's jump over to Excel. We're going to do some data sorting, which is kind of cool stuff in Excel. Pretty powerful. So I'm going to go ahead and share again. Going to go over to Excel, and we're going to go ahead and get started from here.
Hello, everybody, and welcome to Lesson 7 of the Ben and Boz Microsoft Excel video tutorial series. I'm Boz.
I'm Ben.
What's going on today, man? I'm pretty jacked up. How about you?
Well, I was going to say, it's naturally just a great day up here, but talking about Remember the Titans got me a little bit jacked up before this video.
We talked about one of our favorite movies to get ready
Best
for.
soundtrack ever.
It's going to be a good one today. Not as many keyboard shortcuts, but we're still going to learn how to get a little bit better navigating on large data sets. We're going to look at how to provide some summary information, not through pivot tables like we did last time, but using subtotals this time. And then we are going to improve our printing skills on some large data sets. Again, adding a little bit more from what we talked about in a couple of previous videos.
Yeah, totally. Our first few videos were kind of the non-negotiable keyboard shortcuts that we think people just have to know. Now some other techniques. Freeze panes, it's critical to do it. You'll learn how to zoom in and out, adding filters. You and I both love them. Sorting data, we do that all the time. You'll learn how to subtotal, and then just more printing techniques. Let's do it, man.
Let's get into it. So what we have here is an asset listing from July. I'm just going to kind of scroll through here. And Boz, what is this number? 148951. What does that even mean?
It is something related to building, if I look over to the left, but I do not know exactly what it is.
What's this one, though, the 637?
I could probably make a guess, but I wouldn't know for sure because I can't see the column header. I wish I could really see it. You know, I have a longer set of data.
You know, we're not the first ones to ever have this issue here. And so Excel actually created something called freeze panes. So when you freeze panes, it's going to keep, this is the first one here. There's 3 different types, but for the first one, we will just freeze this top row. And that allows us then when we scroll down, this top row will still be visible. So we'll know once we're like deep into a data set, we know what this number is or what this number is. And what it
Absolutely. And
represents.
just freeze on the top row, that is the most common thing I would do here too. So
Interesting. I usually use a different type of freeze more often. So
Ooh,
you will go
interesting.
over to the data tab. I'm going to make sure I selected 2 or row 2 here.
Yeah.
And then under, oh, sorry, not data tab, in the view tab, I'm getting ahead of myself here, you see freeze panes,
Yeah.
and it says freeze top row. It actually doesn't matter what you click on. Even if you click down here, you can do freeze panes, freeze top row. And now, I don't know if you noticed, but it's a slightly darker line under
I can
row
see it.
1. And then you scroll down. And now, if I ask you, Boz, what is 1,666? What is it?
it is depreciation per month. I can see it with the column header.
Look at that. Perfect. So
Magic.
that is one way, apparently Boz's most common way to freeze panes. If I ever want to remove that, I just click on freeze panes and select on freeze panes, and then it goes away.
All right.
Another common way is, say I just want to freeze column A.
I almost never do that one.
I pretty much never do just column
it's
A.
possible you
It is
would,
possible,
yep.
yep. So that would be the first column that you want to freeze. So you go into View again, Freeze Panes, and freeze first column. And now if I scroll over to the right here, you can see my asset number is still visible. If I had a whole bunch of headings out here, that might be useful. If I had just more information about the assets that I wanted to see,
Absolutely.
I could do that. And then the one that I actually use most commonly, this one, I'm going to unfreeze panes again. This one, I click in cell B2, and then with the freeze panes, I'll just use that first option, freeze panes.
I still do that one quite a bit. I will say I probably more so just freeze the top row, but well, that's obviously it just depends on what sort of data you're using, right? So this one certainly has massive amount of use as well.
Exactly, and so that froze both the row and the column. So if I scroll over, the column A is still there. If I scroll down, the first row is still there.
Yep.
And what I like about this one too, say it was like first name, last name in A and B, and I didn't want to just see first or just see last name.
Yep.
What I can do is, well, first I'll unfreeze my panes, then I'll click over and see, and then I'll do freeze panes.
Yeah.
And now both A and B are frozen. So I can freeze as many as I want. And that works the same top down as it does.
Yeah,
left to
there's
right.
times when I've wanted to freeze the top 6 rows, the far left 3 columns or something like that. So that's a really, really flexible option. It's awesome. I've been using that one
Pretty
for
powerful,
20
pretty
Cool,
graceful.
so it must be good, oldie but a goodie.
Yeah, it is. It is. It's got one of those non-negotiables.
All right, well, as long as we're talking about 20 plus years, Boz was telling me before we started this video, it's a little bit hard for him to see these numbers, even though we blew it up on a huge screen for him, but with
Making
just
fun of
natural with age, your eyesight doesn't get quite as good.
There's
So
some truth to that.
So if I'm gonna zoom in here, Boz, what's one way that will always work no matter what for zoom in?
Well, are you talking about going to the lower right-hand part of the screen and then just clicking on that plus? Is that what you're getting at?
Yeah, so you can click on the plus, you can see I'm getting a little zoomed in, click on the minus, it'll zoom out. You can actually
It's like
take the
Word.
bar yourself and just slide it however you want, that'll work too. Do you have any other shortcuts that you typically use when you're zooming?
If I was to be using an external mouse, which I don't do very much, but if I was, I would press the control feature, and then I would scroll back and forth with the mouse, and then that would do it.
Absolutely, and that works if you have an external mouse. If you just have a mouse pad like I'm using, you can hit the control button, and then with 2 fingers, just like squeeze your fingers together, like I'm doing now, that zooms out, squeeze your fingers out, and that's gonna zoom in, kind of just like, like a picture on your phone or something like that. If you wanna zoom in or out, you can do the exact same thing.
That's
Just hold
the one
control key.
benefit of the mouse pad. I hate the mouse pad personally.
Oh, actually, you don't have to use the mouse, you don't have to hold control to zoom in and
nice.
out on the mouse pad.
Nice.
Yet another benefit of the mouse pad.
I love it. I love it.
All right, so next up, we have a large data set. If I just do control to the bottom, you can see there's 200 different things, and I want to organize this a little bit better. It looks like they've just kind of been added by asset number here, but it's not really organized by asset type or by purchase date or anything like that. So one common way to do this, again, if
This
you
is
don't want to use
powerful.
pivot tables, sometimes it's easier to just do it in your data, is to add a filter.
Oh,
That
I
helps
love
you
filters.
navigate around. And we actually have different ways of putting in the filters. Probably the
Data
slowest
stuff is
way
cool.
is if you go up to the data tab and you
gonna
see
count.
sort and filter, and you can click on filter, and now you see these little arrows have popped up in the side of the cells, and so I can select just automobile or just computer or whatever I want. But before we get into that part, I'm going to hit Control Z to undo that. And Boz, how do you like to add the shortcuts?
Well, I didn't even know your shortcut, so the one I've been doing forever is Alt-AT, and so you press Alt and then A and then T, and it just kind of is a way to get to that filter, and it works. I think yours is probably, half second faster per time, though, so I'm interested to see you do yours again.
I think it's similar to the Control D, Control C, Control V debate of lesson 6 or whatever it was. So what I like to do is Control, Shift, and L. You just hit them all at once, and that filter pops up.
That's beautiful. And Ben and I joke there. I mean, whether you're doing the Alt thing or that Control thing, both of those are significantly faster than using your mouse and going up to those top ribbons there.
Yeah, and so once you have a filter on, I mean, it's just exactly that. It's a filter. So let's say I only wanted to look at equipment. I wanted to take everything else. I'm not deleting it. I'm just only showing the equipment. I could click on the little drop down. Automatically, everything is selected. I could check that box to make sure nothing's selected right now. And if I just want equipment, click on equipment, hit OK. And now all that you see, all that's displayed here is just the equipment.
It is so cool. I don't know that they had this one in the early days of Excel. Maybe they did, and I just didn't know it, but this one is so cool. I use stuff like you just did all the time.
Yeah, and then when you want to clear the filter and move on, typically I just actually click here and then do clear filter from asset type.
I think I hit Alt-AZ again. Can you do an Alt-AZ? Does that just get rid of it again?
Yeah, so just so you guys remember, Alt is like the hotkeys. So Alt, and then the data tab is A, and then to clear is C. Is that what you said, C?
Well, actually, I would have done Z, but maybe I have to do clear for C. Does Z work or not? No, so Alt-AC, is that what it is?
Alt-AC did work. Let's
Okay, Alt-AC, gotcha.
Let's do Alt-AZ. That
No, it
one
doesn't
did not work.
So,
Yeah.
no, I bet I was kind of slow. I wouldn't doubt if I cleared it, and I went up and I did it manually now that I think about it. Does your Control Shift L thing, is that what you do? Does that work to clear it?
Yes, and so if you want to just even remove the filter, I'll just do Control
Oh, that's
Shift L,
perfect. That's how you
and
gotta
then
do
it goes away.
That's how you got to do it.
Yeah,
Right
there you go. So that's a little bit about filters. A cool thing with filters, though, besides just like taking out subsets of the information, it also helps you sort the info. You don't need a filter to do it, but typically every time I'm going to sort it highest to lowest or A to Z or whatever it is, I'll just put on the filter because I'm probably going to do some other manipulation as well.
Exactly.
So anyway, within the filter, if you click into it, you can sort, and this is asset type. So if I go A to Z here, it'll go automobile first, and then if I go Z to A, it'll go furniture first because that's the lowest one. If you switch over to, say, depreciation per month, you can sort A to Z, Z to A is actually just smallest to largest or largest to smallest. So that's usually the way I do any sorting. Boz, you do anything different with that?
We were discussing if you needed to do like a two-pronged sort. So like if you wanted to get, just show all the asset types, but show like their dollar amount in order, there's probably 2 ways to do that. So if you did cost, and let's do cost, and let's do a Z to A sort on that one. All right, so largest to smallest. And now let's do asset type, and let's do A to Z on that one. So what this would do, now it brings up your asset types. That's a way you kind of do two sorts together and get that to happen. If you ever needed to do three,
and just so everyone, when you're watching, you see that automobile is like all the automobiles are together,
Yep.
but within automobiles it's listed highest to lowest. So by putting on those two sorts, that's what we did. Before it was all listed by asset number, so you wouldn't see that.
yeah, and if you ever needed to do three sorts, I don't think this table I would ever do it with, but that's where I would just go up to, and I probably hit probably a Control A to highlight everything. I think I would do that first, and then just go up to the data ribbon. You're on it, and then to sort. Actually, click on that button, sort.
I like the sort button myself.
And then, I don't think you even have to do it, but in the upper left-hand corner there, you can see add level. Just click on it a couple times. Even you can just add in if your data is the type that needs to be sorted several different ways. Usually, you're only going to be doing it one or two ways. You can just do it in the filter like we showed it.
Yeah, and typically if it gets more complicated than just like a couple of sorts, then I'm just going to use a pivot table.
That's
anyway.
true, too.
So it's nice to know that it's there, but you don't always have to use that.
Yep. I
Beauty
use
of
those
Excel.
a lot, but now with the filter, I use them less and less.
Yeah, there's so many different ways to do things in Excel. It's kind of nice. All right, well, let's move on and talk about subtotaling. So subtotaling, again, is a cool thing you can do. Let's say I want to have a breakout that
Another
shows me just
powerful
my
feature.
automobiles or just by asset type. What's the total cost of those? What is the depreciation expense per month of automobiles? And maybe what's my total carrying value left of the automobiles? Just random numbers, essentially. So if I want to add a subtotal, I'll go up to the data ribbon, over here, the outline section, and then you can say subtotal. And what this does, it kind of just takes you right through it. So at each change in asset number, well, I want it by asset type, and it's already sorted by asset type, so it'll work. So at each change in asset type, use this function sum. You could do average, max, min,
I
whatever.
usually do some there.
Sum's
Yep.
pretty much the default here. And we said sum up the carrying value, that works. I wanted the depreciation per month, that would be a good one. And then I also wanted the cost.
Yep.
And so now if I hit OK, it's not going to look like anything changes too much, but notice everything will move over to the right, and they'll put in some secrets over here, I guess I would say.
I like it. So it looks like nothing's changed, right? But you have to go up and now click on the one or two or three. And what view are we in right now? We're either in one or three right now. I know
We're in
two.
3 right now, so everything is showing. And even before I click on it, you see it says automobile total, and this adds up my total information that I have here. That's my depreciation, that's my cost,
Nice way to
and that's
subtotal
my
things.
carrying value.
Very
So
graceful.
if I wanted to get rid of all this detail and just show the totals, I could click on 2.
Yep.
And now it just shows me, oh yeah, here's everything for automobiles, buildings, computer equipment, furniture, so on and so forth. And if I wanted even one more summary to just show the grand total, I click on
Grand
1,
total.
and it goes back right there.
Yeah. So if I'm ever using this one, I'm usually doing the view number 2 right there, and just to see it, I think Ben and I would both usually use pivot tables at this point in time instead. I used to use subtotals more before I got comfortable with pivot tables. So
Pretty
it's
much.
there, but just be aware it's there. But you're probably
One last piece before we move on from that. If we wanted to break out, say, the buildings, but not everything else, you can just click the plus next to the buildings, and that shows us all the detail that's going into those totals that you see there.
So with certain sets of data, being able to do that pretty flexibly has a benefit for it. So just make it aware it's out there.
When you want to get rid of your pivot or your subtotals, you can hit Control-Z a bunch, or you can click onto this outline button, subtotal, and then remove all in the bottom left here. And now it goes back to the way we had it.
All right.
Hey, we've done quite a bit. Let's finish up, though, with a little bit of printing.
That's
A
right.
little bit more on how we do it. And the two we want to show you this time, print titles and page breaks. Boz, you use print titles pretty often?
Yep, all the time. So it's because if you don't, well, I think the example is just go ahead and do a Control P right now, and let's look at how it would look, and we can see what we've got on the first page. And I think now so we instantly are on the next page, and it kind of goes to the point you asked me at the start of the video. It's like, Boz, what is this? It's like I don't know. It doesn't actually have a title on there or a column header. So if someone were to give this to me, just like this, I'd basically hand it back to them and say, clean this thing up and then bring it back.
I thought you were going to say you're going to get a bunch of tape. If you tape them all together, so then you can go
Well,
all the
literally,
way
that's
out.
what you'd have to do if you didn't know how to use this, right? Which is crazy.
All right, so print titles. If we go to our page layout ribbon, and then it says print titles right here under page setup. So print titles, and what we want is to repeat our rows at the top, just like freeze panes. So in this box where it says rows to repeat at top, I click in there, and then I just click anywhere. Notice I don't have to click on the 1. I have that sideways arrow no matter what. So just click somewhere in row 1, and so it's going to repeat row 1 on every page. If I hit OK, and then do a Control P, now you can see if I scroll down to the next page, I have those titles there. Even though I'm on page 4, I still have my titles right there.
Very nice, very nice.
Yeah. So that's how you would do print titles. Now the last one we want to
And
show
you could
you.
also have printed, you just showed how to print, the top row, right? And you could have just, if this was a very wide spreadsheet, you also could have just done columns to repeat at the left as an example.
Absolutely.
If you needed to.
Yeah,
I
if
don't
you
do that
just-
probably as often, right? I probably usually do that top row.
Yeah, I pretty much never use that, and I'll try and get all the columns on one sheet, either by going landscape or changing the page breaks.
Oh, that
Look at that
transition
lead
right
in.
there.
So Boz and I actually do page breaks a little bit differently. The first thing I guess that I'm going to do to show you how the page breaks come in, I'm going to switch to the View tab and do page break preview. I like this one because it shows us where our pages are going to be. And right now you can see we have A through F going on page 1, and then it goes all the way down 2, 3, 4, 5, and then starting page 6 has columns J through K. And so to fix that one, I would probably just take this this line here between F and J, drag it over, and now everything's going to be squeezed onto one page
So that
automatically.
auto sizes your file a little smaller than by
It
doing
does.
that.
It'll take
That's
that
cool.
zoom that we showed them
Yeah.
last time. Instead of trying to guess 80% or 90%, it just automatically picks the most efficient one that fits all the columns.
That's pretty slick.
Now with page breaks, let's say we want to break this up. So automobiles are on one page, and then buildings are on page 2, and then computers on page 3. How would you go about doing that, Boz?
Well, normally how I would do that is not through the page break preview. So normally I would go back to the normal preview and I would just go beneath the automobiles then. So scroll to the end of your automobiles. And then I usually would click on cell. I believe it would be A42 is where I would do it. And then I would go insert, I believe it's insert.
Page layout.
Page layout. Yep. So page layout and the brakes right there actually. And then insert page break.
There you go.
And I would go down underneath the buildings and I could do the same thing. I believe we're going to teach them this one in the future that there's a function called F4 that you could use just to repeat that if you're doing that a lot.
And you can see that the line between automobile and building on the screen here got a little bit darker, and that's a way to see that you have a page break there. Or you could hit Control P, and now you just do a little quick preview. Automobile is the first page. If you go down the second page, you see building, and we'd add another one after computer.
All right, gotcha. So how are you going to put that one after building? Now we saw how I got it in after automobile. You got a different style, you said.
Yeah, and actually I use both ways. It just depends. If I want a whole bunch of breaks and to create more pages, then I'll go this way, entering the page breaks, then just using F4 to create new ones. Otherwise, though, I'll go back to View and Page Break Preview, and I like this because it helps kind of show it to me. And so here where I have a dotted line partway through computer, I'll just click and drag that to be between building and computer.
Sure.
And then this other one for computer and equipment, I'll do the same thing to drag it in between. And then furniture would be the last one. I'd put it there, and I see, all right, it all fits. And if I do Control P, I know every single page is building, computer, equipment, furniture. Excel went a little crazy on me there.
Pretty graceful.
But there we go. So it all works just different ways, and it's whatever you want to do. Let's see, we've talked through freezing panes, zooming in and out, just with the mouse pad or controlling the mouse pad, depending on what you're using, adding filters, sorting subtotals, and then a little bit of printing stuff. Anything else?
No, I think that's a wrap, man. So thanks everyone for tuning in to
Good to go. All right. Any questions, comments? This is pretty graceful stuff. Some of it you may have seen before, some you may not have, but it's just powerful when you're going to execute, print out, view these spreadsheets and access the data, sort the data, subtotal the data. On that note, I'm going to wish you a wonderful weekend, and I will look forward to your return on Monday. Any questions on the weekend? Feel free to give me a shout. We'll talk again soon. Have a good one, 2 or 3.
Have a good weekend.
You too, Alexis. Thank you.